of our classes. So if you go to fidelity.com/coaching, you'll see on the left-hand side under events, we do have a list of classes that we host every single month. And a lot of the topics we're going to talk about are in the later classes of our trading basics class, where we talk about kind of some of these basic concepts, because we want to, from the very get-go, from the very beginning of trading, we want to think about both making money, but also what can go wrong. And this concept of managing risk, protecting ourselves, it doesn't go away. As somebody who's been trading for a long time and joined by my colleague today, James, that's been trading a long time, I think longer than I have actually, this concept does not go away. It becomes more and more important, especially the more trading we do. If we use more sophisticated strategies, again, it just becomes more and more important. So let's kind of cover our rough agenda for today in terms of what we're going to talk about. And then we do have some flexibility. If, again, a lot of questions pop up, if certain concepts don't make sense, we can dwell on one concept a little longer than another. But we're going to talk about the idea of position sizing. It's a nice term, and a lot of people say, what do you mean by position sizing? It's how big are our positions? How big, if we buy a stock, how much stock should we buy based on how much we want to risk? And then in addition to, okay, being careful about how big bites we're taking, so to speak, we're going to talk about using things like stop orders. Of course, we can always close out a losing position at any time, but it might behoove us to maybe have an idea or picture in our mind an area where, hey, if we were going to enter a stop, where might we put it? How much risk would that be based on the opportunity we are expecting? Does that risk kind of make sense in terms of having an attractive payout if we're correct, and having a lower amount of risk if we are incorrect? We are going to talk about some technical indicators. There's many different things that can help us in terms of identifying trend, support, resistance, and all of these things can help us when we're kind of trying to visualize and talk about and even quantify that risk aspect. And we'll leave you with some resources, of course. Humble plug. We want you to, if you're new to this session, if you haven't joined us in some of our other sessions before, would encourage you again to go to fidelity.com/coaching and check out some of our many other sessions. And if you're somebody that trades very actively, you really should check out our briefings. It's a great way to stay plugged in and to stay in the know with trading and with investing. So, big kind of topic. Let's talk about the idea of a trade versus an investment. Now, they are different things and they're not mutually exclusive. You can do both. You can do a hybrid of one or the other. But I think there's different thought processes that go on in terms of, hey, this is a term trade. I'm bullish over the next 2 weeks in, tech, small caps, whatever it is. Or I want to have a longer term exposure to those same asset classes, and I expect to have a decent rate of return over maybe a 3-year time horizon. So those are pretty stark differences, but it tends to become a little bit murky when we're talking about something that's maybe 3 months, 6 months, a year out. I think there's different people will define these kind of differently, but the stark difference I would say that comes to my mind is investment tends to be longer term. A trade tends to be shorter term. As a trade, we tend to look at trend more, use a lot of charting more, use a lot of technical indicators. Whereas an investment, we tend to look at the business more, do a little bit more fundamental analysis. And again, we can use fundamentals in making a shorter term decision. We can use technicals to make a longer term decision. But I think investment or investing tends to be a little bit more fundamental heavy. Trading tends to be a little bit more chart and technical analysis heavy. So those are some of my thoughts initially there. James, let me open up the mic to you, sir, and get some of your thoughts as we start out talking about having an exit strategy. I think we want to be careful not to mix a trade with an investment because, again, some of those concepts, some of those thought processes
Yeah,
are a
and
little
it
different.
really helps when you're kind of having that designation between a trade and investment. It really helps you with your kind of mental approach to, well, days like today. If you're an investment with a 10, 20 year or even longer horizon, days like this are really nothing to worry about because you're there to ride it out. And this might even be a welcome thing, right? If markets go down, that could be to some extent to your advantage. Now, if you were planning on buying, you can, right, buy something on sale, right, so to speak. That same dollar value that you had, say, last week, well, now you can purchase more shares, so you get more bang for your buck. Now, when you have a trade, okay, these are the days that it can be a little bit fearful for you, depending on whether you have a plan or not. And Troy, I want to open up the mic back up to you for a moment because I agree with you perfectly when you said today is a perfect day to talk about this topic. However, if you're someone who's thinking about an exit plan, is it really on a day like today where markets are, some news providers will say, right, in terminal, they'll have that flash across the screen? Or is it better to do it when markets are at all-time high? So, Troy, when's the best time, in your opinion, to kind of plan your escape? Is it on a day like today or a time when the markets are at an all-time high, possibly?
I think that's a great question, James. I think it's better to have an exit strategy ahead of time, right? We don't want to wait till things go bad to say where are the exits. We want to have that ahead of time. Again, when markets are at all-time highs, everyone's celebrating, and it seems like, hey, it's so easy to make money in the markets. And then when things go bad, everybody starts hedging, everybody starts selling, and so sometimes it's that crowd mentality. So ideally, we want to do it ahead of time. Of course, again, the question is, could it get worse or could it get better? And so it can always get worse. So, there's kind of the best case scenario, and then there's sometimes we get caught in a situation where maybe we didn't plan as good as we could have ahead of time. So that's a really great question. I think we're better off to have an exit strategy when things are good than to start planning when things are bad.
Yep, absolutely. And I like to use the analogy, and I use my own kind of analogy for kind of having a plan. It's like when you're on a road trip. I like doing a lot of road trips here. And sure, you can, right, if I was going to drive from where I'm in New Hampshire to where Troy is in New York, I could probably do it without a map. I can read the signs. I can kind of figure out my way down there. But if I'm hitting bad traffic going into the city and maybe I need to take a deviation to my route, I might get a little lost. It's probably going to be a little bit stressful. I'm not really going to know where I am. I'm looking at the signs. But if I have that map, that plan, kind of that pre-prepared like route, and an alternative route, and maybe a backup plan if the George Washington Bridge is busy, for example, there, well, I'm going to feel a lot less stressful when I'm making my trip. And that's kind of the analogy I'd like to think of when you're trading. Then on a day like today, where markets are selling off, right, hundreds of points, if you have a plan, you're not really going to be stressed out, right? You know if you're going to be getting out or not, and ideally you have a way to mitigate those losses from continually getting to kind of go against you or adversely affecting not only your trade, but your entire portfolio. So this kind of going forward now for the rest of our session, hopefully we've made the case, right? The importance of having a plan and planning your escape for days like today or a series of days like what we've had, or maybe you haven't hit your threshold yet, but having that plan can help you sleep at night and ensure that you have long-term success as a trader, which far too often traders have great starts and they fizzle out with loss after loss after loss, or possibly one large loss that puts an account in ruin. And the risk of ruin is very real. Sometimes it only takes one trade that you let get away from you to end your trading career. Because our jobs as traders, first and foremost, it's not to make money. Many of you could have spent decades or your entire professional career accumulating the assets that you have, whether that's for investing or for trading. The last thing you want is for one mistake to kind of take away years of what you could have worked towards. So we're going to be kind of breaking this session just to, in my mind, I like to think of it kind of into two ways. The first half, we talk about kind of some ideas, ways that you can kind of define risk. And then we're going to jump into some charting techniques and some trading techniques to help you kind of think of ideas of what could cause you to exit your position. So when it comes to kind of defining risk, I would say kind of one way that we can do so is to kind of set either a dollar or percentage amount that we can use. And we've got a few examples here, and I really like both approaches because they're slightly different, but you can see the similarities. Now, this first kind of bullet point as a percent of your stock price. And this is, it's meant to be one size fits all, but it really isn't, I would say, the best way to do it in all stocks in all circumstances. But IBD has this kind of guideline of 8%, where a trader shouldn't be taking, say, 8% on a particular trade, a loss of such amount. Now, I think that's going to be very much subjective based on what you're trading, right? 8% on something like the S&P 500, well, that's a meaningful pullback, right? If 10% is correction, you're almost in correction territory from your trade. Now, 8% on a stock like Nvidia, well, that's over the past week, an 8% move has been kind of par of the course. So it depends on the underlying that you're choosing, but an idea of setting a percent loss as your guideline can be a kind of one of many ways that you can help plan your exit strategy. And later on, towards the end of the session, we can talk about other ways to possibly get to that percent, right? As we've kind of talked about, 8% on the S&P, very different than, say, 8% on NVIDIA or Tesla or even most single stock names. Now, another kind of way to determine your risk amount is setting it as a percent of your trading capital. I'm a kind of a big fan of this because this has the benefit of automatically kind of adjusting your risk tolerance based on your position sizing. And we'll talk about another kind of variation of that later on. But there's this idea of what's referred to as the 1% rule. And you could kind of modify this into your own maybe 2% rule or 3% rule, but it's still designed to be kind of on a smaller kind of single digit percentages, where if you have your trading account, and this is different from your entire net worth, your entire, say, portfolio at Fidelity. I think many clients that I've spoken with in the past, they'll sometimes designate funds. Sometimes they'll call it play money, they'll call it their trading money. It doesn't matter what you call it, but they'll have this kind of designated account specifically for their trading, their, I guess we can say, their kind of attempts at their own self-directed success. And with that capital that you've set aside for trading, you'll establish yourself, say, 1%. We'll stick with the basic 1% here. You're not willing to take more than 1% of that entire capital risk on any one trade. And what I like about that is it somewhat tailors to the sizing. So let's say we're working with a $100,000 account. So 1% of $100,000 is 1,000. So that's already going to be kind of established there that $1,000 is going to be your max amount of risk per trade. So if you were to be considered a kind of a very risky approach to this and a very concentrated approach and put all 100,000 in one stock, well, and you're only risking $1,000, that means your kind of threshold of when you're going to exit the trade is a 1% loss on that position. But let's just say you're maybe going to diversify the account a little bit here. You've got 10 stocks at $10,000 each, $10,000 position. What is $1,000 of a $10,000 position? Well, it's 10%. So now you've given yourself far more wiggle room when the single position is smaller. And let's say you have maybe just, not that anyone would want to do this, but 100 stocks. You're diversified across 100 different stocks and you've spread it between $1,000 for each stock. Well, in that case, still by following around that same logic, you're willing to take $1,000 of risk. So you're willing to take not that anyone should do this, but 100% loss on that position because it's such a small percentage, right? Only one stock is just 1% of the entire count. So using that idea can help you with not only establishing a guideline of just how much risk you're willing to take, knowing that you're cutting them small no matter kind of what the charts are telling you, but also you're thinking to yourself, well, hey, I want to buy, I'm going to use a stock here, right? Tesla, for example. Well, $1,000, 1% of Tesla's is a normal daily move, so to speak. So it's not, doesn't make sense to put all my capital into, say, Tesla stock if 1,000 is going to 1% is going to shake me out of the trade. So possibly lower that position sizing so that that $1,000 risk is going to be a larger than, say, 1%, right? Maybe it's $50,000. Now it's you get 2% wiggle room. $10,000 of Tesla gives you 10% wiggle room, right? $5,000 of Tesla now gives you a 20% wiggle room to the downside before you've hit that 1% rule. So these kind of two ideas are going to be, I would say, helpful for folks if they're interested in kind of at least trying to establish some type of guideline, their way to define risk. Is it a percentage of the stock price? Is it a percentage of your trading capital? One more that's not listed there, or any set dollar amount that you choose. If you're saying, I don't want to lose any more than, say, $1,000 or $2,000 on a trade, no matter how big it is, well, that's perfectly fine because it's your way of defining risk, kind of without regards to any other factor, such as what the charts are telling you. So, Troy, I want to stop there. Maybe for this session, we can do a little bit more kind of back and forth and have a little bit fun here. So, unless there's anything you wanted to add on kind of this way to help kind of define and determine risk amount, I can kind of let you talk about the next area where we can maybe set some orders to do so.
Yeah, James, I think this sizing aspect, again, I don't want to kind of discount how big a deal this can really be. Again, if you have a stock and it's 10% of your portfolio and you give it a 10% buffer, again, some stocks are more volatile than others. So, you can have a stock that's 5% of your portfolio. And, if you give it a 20% buffer, right, 20% of 5% is only 1%. So the idea is we want to take small bites because you want to be careful of kind of putting, everything and all your chips into one trade because we know as traders, we're going to be wrong all the time. I'm also going to put this out there, right? I've been trading a long time. I sometimes make really boneheaded trades, and I'm aware of that. And I don't discount the fact that I could literally sometimes just facepalm myself and say, what was I looking at? What was I doing? But if you take small bites, right, a huge mistake is a very tiny loss, and it's not going to hurt you. There are times where you're going to be wrong just by a little bit. There are times you're going to be wrong by a lot. And so I like to have kind of at the start of any trade, kind of some buffers that are going to protect me from really like near worst case scenarios. There's going to be a pretty rare time where a stock's going to go down. And again, depending on what stock you're trading, in terms of large cap, single day movements, it's rare to have a stock go against you maybe 20, 30%. And again, if you're trading some small cap or some micro cap name, that's very possible. But the idea, again, if you take small bites, the smaller your position sizing, the more you are going to have some tolerance for volatility. So if you're going to give yourself a higher tolerance for volatility, it's going to give you the ability and the benefit to kind of have that wait and see approach. I like to trade as monotone and emotionless as possible, but there are times where I'm like, oh, I really like this stock. I really want to own it. It's just not going up. And the idea is, as a trader, and again, it's going to be different from an investor standpoint. From a trading standpoint, okay, maybe I'm just looking at something bad. If it's having some concept of a downtrend, maybe I can close it, put it on a watch list, wait till it stops doing what I don't want it to do. It starts doing what I want it to do, and I can own it later on. Again, you could use this for stock exposure, for sizing. You can also do it for strategy exposure and strategy sizing. This is a basics class, so we're going to stick to pretty kind of simple kind of trading ideas. But if you're later on with option strategies, with spreads and other things, you can use a lot of these same sizing aspects in the future. So always keep that in your mind in terms of sizing because it's so, so important. So let's talk about stops. So stop loss, stop limits, trailing stop. So a stop loss is a trigger order. It's basically saying, hey, if it becomes a market order when a certain price is reached. A stop limit is a same type of concept, it's a trigger-based order to close out your position. And by the way, a stop loss, a stop is a selling order for long positions. It's also a buying order for short positions. A stop limit is the same thing. It's just kind of not as much of a desperate type of exit. It's kind of a soft exit where it says, hey, if this price is reached, enter an exit order. So if you're long the stock, it's going to be a order to sell, but it's going to be a limit. I want to get this price or better. In a market that's fast declining, like the market we're seeing actually today, you may not have the benefit to wait and see. So that stop limit is again that soft exit. It's not going to be that perfect type of an exit. That stop loss is going to say next available price, I want out now. Keep in mind, there can be some stocks that gap, right? We can close on yesterday at 4 p.m. We can open up today at 9:30 a.m. Eastern time, and the stock can be in a completely different location. Now, we'll show that in just a moment here. A trailing stop is basically it's a mobile, it's a non-stationary trigger-based exit order. What it's meant to do is it's meant to allow a winning trade to run, and then when it stops running, when it stops going in your favor, you want to exit after a certain retracement from the highs. So, for example, that could be a nominal point distance. Maybe you're trading a stock and you're up, $10 a share, and it could be a higher price stock, so it may not be a huge percentage. But if you're up $10 a share, and with some volatility considerations, maybe you're saying, all right, I only want to give it maybe about a 7 or a 6 point buffer. If it tucks in 6 points and you're up 10 points, you're still net positive 4 points, but maybe you think it's going to keep going up. You just don't want it to pull back 6 nominal points. Maybe the stock, before it pulls back a total of 6 points from the high, maybe you get another $10, $15, and it starts going. That could be a good way to kind of again let it go for a while, and then when it starts tucking in, close out and realize some profits. Like anything else, if you put your stop too close with just even a little bit of volatility, it can get triggered, and that can be really, really frustrating. So let me go ahead and just share the screen for a minute, James. I'll give it right back to you if you want to kind of share some of your kind of thoughts in terms of placing stops. But if I use the Active Trader Pro platform, what I'm doing right here on my setup is just using three very simple, straightforward moving averages. I have a red line here. It's a 20-period moving average. A purple line, it's a 100-period moving average. And a green line, a 200-period moving average. There's nothing magical about these numbers, but the red line is going to be my short-term trend. The purple line is medium-term. Green line is long-term trend. I could use other indicators, I could use other things, but I'm just going to use this for a very kind of simple picture here. If we're looking at SPY, I know we got some symbol requests, so we could use some of those shortly. But on a day like today, we got a gap. So if you're saying, okay, maybe you were looking at the price action from yesterday and we closed right here, and you're saying, all right, maybe I want to have this area hold, right? We made some higher lows. That's actually a little bit short-term bullish. So maybe if we were to break that, I want to close, and maybe you would put your stop maybe right here at about, let's call it 539. So I'm going to put a line here at 539. I'm going to color this line. Oh, I don't want it to be confused with my moving average. I'm going to make it red. I'm going to make it a little bit thicker and dotted so we can note that's our stop. Now, the only problem with putting that as a stop is, where did we open today? We opened, SPY opened at 535.75. So if you're saying, hey, my ability to manage risk, I want to put it right there at 539, a stop order didn't protect you. Your order would have been triggered if it was a stop loss, a stop market order. It would have been triggered right at the open, and you would have been filled right around 535-ish, depending on kind of how it traded right near the open. So again, it's not a perfect way to manage risk. Now, you might say, okay, I realized more risk than I actually accounted for. So in a situation like that, that's where the position sizing is going to be your friend and it's going to help you. Because if you got out a little bit past where you would set your risk, if it's a really small size in your portfolio, it's not going to be a big deal. Not going to be a big deal at all. If you make a very big trade, if you go all in or put, 70% of your portfolio in anything and you use it as a trade, well, if this goes against you, $4 or $5 per share past your stop target, that can hurt. That could really leave a mark. So again, that's why it's important to have this mindset of, am I trading versus am I investing? From an investing standpoint, what do we want to do? We want to buy low, sell high. From a trend perspective, we usually want to identify trend, maybe trade with the trend, perhaps buy high and then sell higher. So again, you might ask yourself, okay, Troy, if I'm looking at a chart like this, if I had no exit strategy or plan, what do I do now? But that's a tough question because again, it comes back to what were you trying to do from the get-go? Were you trying to be a trend trader versus were you hoping to be a longer term investor? And be careful of confusing the two. You can do both in the same portfolio. Myself, many other traders will have little, investments, maybe stocks, maybe we use ETFs or mutual funds. And then you can use trades to hedge, to generate income, trade around positions, but just be honest with yourself. If you bought SPY right here at 555 and you said, hey, this is a trade, I would say that's not a bad trade. It actually was working out for a little bit until it stopped. Now, if you're saying, hey, I'm an investor and I'm going to be invested for, 3 to 5 years, again, even though the markets are tucking in, if you have a longer term time horizon, uh, well, from the lows of today, we're only down less than like 5%. So you might ask yourself, okay, on a 3, 5 year time horizon, maybe that's not too much volatility. We know investments most of the time don't go up in a straight line. So you might be more inclined to maybe wait and see versus if you were doing a shorter term trade. Well, if you were trading there, you should have been out a long time ago because there were multiple signs that were telling you, trouble is short-term trouble is on the horizon here. So again, if this was a stop loss, gapping risk is a real thing. This is a smaller gap. There's more kind of substantial gaps that we can look at and use. But the point remains that, again, stop loss, it's a method, it's a technique to exit and to manage risk. It's not a perfect exit. It's not a perfect technique because securities can gap lower and then you are getting filled at the next available price. If you put a stop limit, so if I said, hey, my stop is 53.90, and by the way, stop limit, you can have one as your trigger, and then you can have a limit be something different. But let's just say my trigger and my limit was 539. I actually would not have been filled because this whole session of SPY, it's not hit 539. So I wouldn't have gotten filled. So again, that's why that soft exit, stop limit, it's not a hard exit. If you had put, let's say you were, buying SPY around here at about 545, and maybe you put a 10-point trail, well, that trail would have come all the way up to the high point here, and your high point on yesterday's session was 554. So that would have put a trail stop at 544. So again, we opened at 535. So same type of deal. If it was a trail stop versus you could have a trail stop limit, um, you wouldn't have gotten filled if it was a limit. If it was just a market with a trail, same type of deal as a stop loss. So hopefully that made sense. I know we went through a lot of those different orders, but the idea is you want to have some target in mind. It doesn't have to be an exact figure. You can look at a zone and you can say, for example, if I get rid of this line, and often what we'll do if you join us in a lot of our market briefings, we'll use something like a rectangle to highlight a zone because sometimes, once you know it, a price goes to an exact point and then it can V-turn very quickly. So sometimes you might want to wait and see and have kind of an area and say, how does it trade around this area? Well, here's an area that we gapped and then pushed higher and defended. And you can see we were flirting with this area for several different sessions. One, two, We could even include this if we want, 3, 4, 5. So 5 different sessions. It's not a strong, it's not holding in a strong way. A strong hold is we touch a little bit and then we bounce right off. It's been kind of settling there, like it was getting comfortable, maybe a little too comfortable. And then today we gapped lower and we're actually pushing lower. We are off some of the lows of the session. So we'll see if maybe we get a little bit of a bounce. It's no surprise. 100 moving average, nice round number. We're trading right there, the lows of the session. We're very, very close to it. So this could be an interesting area to hold. But in the near term, this is a support that has not held. Now, concepts of support and resistance tell us that when support doesn't hold, continued bearish price action, that should now become resistance. That means if the market's to recover and try to trade above on SPY about 540 to 542 and a half, we would expect it to not hold and to head lower if it's bearish. If it was bullish, it should retake and hold this zone. So this zone is not a prediction, it's an area to watch, because if it were to take and hold, that's bullish. If it were to attempt to retake and fail, that would be bearish. So, James, is there any questions that you saw? Maybe you'd like to draw some other lines yourself, or any other comments you'd like to make here?
We got a few more questions regarding the stop and the stop limit, but don't worry, I'm going to circle back to those. I want to introduce one more order type, then we can kind of show them all together on one page. And that was on the slides that Troy was just on. And we can take a little bit of a kind of variation of both the stop and the stop loss and add an extra bit of, well, automation. And that's by putting on a trailing component. And we can set either a dollar or a percentage trail amount to kind of just really make sure that we're doing kind of less work. It's just to make our life a little bit easier. So what do I mean by the trailing component? So there is, I think this kind of graph is one of the best ways to kind of illustrate just a sequence of events, or we can call this a trader's journey of placing a trade, using a stop loss, and then watching how that stop loss moves in time. So in this case, let's start with number one, where you buy XYZ stock at $25 a share. Now, in this case, maybe you ideally you would set your exit plan kind of right when you get into the position, whether that is a stop loss, trailing stop loss, or even just the plan to get out. We don't necessarily need to have stop orders, but they're just ways that can help kind of automate when we exit. But in this scenario, bought it at $25, and the good news is it went up to 27. We can follow along at step number 2, the price rose to 27. Now, at this point, you place a sell order, a trailing stop loss with a trail of $1. So what that means is that $1 beneath whatever the current price and the high price going forward, the stop loss will be $1 beneath it. So at the time, if the price was 27 and we set a $1 trail, well, that means our stop loss is at 26. And as we can see going forward, maybe at this point here, we possibly get to maybe 27.50. And it moves directly up from there. We can see maybe a little bit of noise on its way up. So at 27.50, at our new high point, that means our trailing stop loss, because it's trailing by $1, has become 26.50. Now going forward, the price drops back down to maybe 27.10. What is our trailing stop loss at that point in time? Well, it's still $1 from that prior high point, which was 27.50. So our stop loss remains constant, in this case at $26.50. So at number 5, I think they're using a different price there, but I like the 26.50 here. And let's imagine the price now starts to rise again. It was only after it got above 27.50, this high point, that the trail amount starts to increase. And as the price continues to rise until we get to $29, well, it's going to continue to rise along with it. Eventually, we get the high point of 29, which is, as we can see on this chart, the highest point that we reach. That moves our trail amount to $28, still $1 less than that high price. As the wrong way here, as the price continues to drop, following this high, the trail amount remains stuck at $28, which was $1 from 29. And eventually, if it were to occur intraday, we would then be exiting at that price of $28 or around $28. So all the trailing does is it moves the stop loss up along with you. Now, I noticed we had a few questions just to kind of demonstrate what the orders look like when you're creating them. And I noticed that one of the questions was actually doing it in the trading dashboard. So Arvind, I saw your comment. You can demonstrate it in the trading dashboard. And certainly, now for those of you that haven't seen the trading dashboard, it's meant to be a kind of a one-stop shop for trading and placing orders on Fidelity.com. The trade ticket looks the exact same as if you were to go to accounts and trade or click on the black trading button here. So take a look at how it's set up. It's going to look just like this in the dashboard. So clicking on accounts and trade and going to trading dashboard, it's going to take a little bit to load. And your trading dashboard might look a little different depending on all the settings that you've used. Just for the screen share, I'm going to set this on the white background. And we're going to minimize this chart, just so we have what I imagine most folks are looking at. One of the symbols that came in, Karen, I saw that you gave us General Motors, so we'll use that as an example. I think they're in the 40s, yeah, $41. So let's go through the kind of setup of the stop orders, the trailing stop orders, and I'm going to throw a little bonus here. We're going to talk about a conditional order, which is the same as the stop and the stop loss orders, just with your upside target as well. So in order to kind of, let's say we have 100 shares of GM in our account. We bought it at, you know what? Doesn't matter what we bought it because we're focusing on our exit. But let's use a number. Let's say we bought it at $30 if we come back to it. And we're happy that we're still making money as we're up from 30, we're up $1 and or $10.58, $11.58. But we've seen a steep decline from 50 all the way. So unfortunately, this trader is only thinking now about putting in their exit plan. So we've told ourselves, okay, let's set up a way to automate when we're going to exit the trade. So we'll go over and click on sell. What that's going to do is on the right-hand side, give us really the same trade ticket that we're used to seeing. So let's go over a few different choices. We talked about $100, 100 shares. Now, you're probably used to market order if you're just getting out at the current price, or limit order if you're looking to get out at a price that's above where it's currently trading at when we bought long shares. We're going to jump back to conditional, but let's take a look at these other types. So the stop loss order allows us to pick a price. So I could say, hey, if it ever trades below $40, we're going to do good till cancel, which can keep an order upwards of 6 months or in or around that number. So if we were to place this order as it currently stands, sell 100 shares of GM with a stop loss at 40, what does it mean? The next time GM trades below $40, it's going to put a market order to get out at that price. And that's it. Ideally, right? As simple as that. Goes below 40, we're selling. Only during the day. I know there's a question, right? Does it apply overnight? It does not. This is only between market hours of 9:30 to 4 p.m. Eastern time. Let's say it closed today at 41.60, open tomorrow at $35. Well, $35 is our first price below 40. So what happens? Well, we're selling it at $35. Why? That's the first time it traded below 40. If it goes below 40 today, well, we're probably going to get right below 40 because it's going to go down, right? Penny by penny, nickel by nickel, and we're going to fill close to this price. The stop limit isn't used as often. And notice now we have an additional box. So instead of going down to 40, triggering a market order that gets us out of the trade, now we put a limit order. Means it has to be now below 40 and then back above the next price. So it's a condition that doesn't guarantee the execution. So I could do the same price. And if I did this, what does it mean? Has to go below 40 and then trade back above 40. Kind of unique, right? What if I did it below it? Well, now it has to go below 40, but then be above 39. If it happens intraday, well, it's likely it'll trigger because it'll go below 40, but that will still be above 39. In the example where it closes at this price and opens up at $35 the next day, with this order, it won't execute. Why? It's below 40, but if it opens the next day at 35 and we put a limit of 39, it's not going to execute. And this could be the same price, it could be lower, it could be higher. Just think it has to now meet both conditions instead of one. Below the stop price and back above the limit. So hopefully that helps. I saw some questions there, just kind of going over that. Again, below the stop price, and if you just a stop loss, then you can get out. If stop limit, it has to be back above. And that same kind of logic is going to continue when you're looking at the trailing numbers. So let's say we did a trail stop loss of $1. If I were to enter this order in right now at 41.55, that means our stop loss price will be 40.55. Oh, and what does that mean with the stop price of 40.55? It has to go beneath it. If I chose a stop limit of $1, the stop and the limit price are the same price. So what does that mean? It's actually somewhat of a disadvantage. Personally, the trailing stop limit, I'm not a fan of because it puts both the stop and the limit order at the same price. If we just do a regular stop limit, we can pick two prices. A trailing stop limit, only one. So maybe a trader's kind of tip here. Stop losses, stop limits, perfectly fine. If you're adding trailing, oftentimes you're just doing the trailing stop loss. Dollar percentage, it doesn't matter. It depends on how you like the math. Do you like to think of it in dollars or percentage terms? If you want to do a stop limit, you're more often, the best case of action is to establish your stop limit order and then adjust it as you see fit. Do you have to do more work? You do, but now you get to choose a separate stop and limit. And again, one more kind of trader's tip. Majority of clients I see, they just use the stop, the trailing stop or the regular stop loss. They don't like the limit because it doesn't guarantee they're going to execute. They only use the limit when they're trying to kind of not get out if it goes too low on an overnight movement. So hopefully that helps there. Now, one final order type is the conditional. This is a kind of a fun order because we've only been really talking about, for good reason, the exit plan when it moves to the downside. If you're trading, it's still good to have an exit plan for your profit target, right? You don't want to be one of those traders that whenever you're making money, that's great, but you don't know when to get out and take that profit. You only kind of realize that profit when you close that trade. So ideally, you're going to have an exit plan, not only to protect yourself against losses from the downside, but also to take your profits, achieve the goal of making money on the trade, booking that gain in the account. What a conditional order type will do is allow you to set a limit order to sell above where it's trading and to stop loss to get you out. They're connected, so you can only execute one at a time. And it's your way to probably the closest thing to just kind of set and forget your trade. Because let's say we bought GM right now at this price at 41.50. And we're telling ourselves, you know what? We bought 100 shares. If it gets to 45, I want to get out and take my $3.50 profit. But if it drops below 40, I want to get out, lick my wounds, and get ready for my next trade. And as you can see, estimated order value A, we're going to bring in 4,500 because we're selling at least $45. Estimated value for order B, which is our stop loss, we could get around 4,000 less if it opens up lower. But what this is really doing, this isn't protecting you. Stop loss does not offer protection. The company could go bankrupt overnight and you're left with nothing. It's not a hedge. It's automation. The conditional order is your way to automate your exit with your with your limit above to sell it at your target price for ideally a profit, and your stop loss below to either sell it at a kind of loss threshold or maybe less of a gain than what it had been. This is if you're doing it after the fact. So hopefully that helps with the conditional order. JW, saw your common trading dashboard when modifying stops. When should your placement be in a below or above your position? Well, so if you're doing stops, keep in mind stop prices if you're long. Forget if you're short, then it's above, but most of you are buying and then selling, not selling short and then buying to cover. So your stop should be below where it's currently trading. If you put a stop above where it's currently trading, it's just going to execute immediately. The same thing if you put a sell limit below where it's currently trading, it's going to execute immediately. It's a kind of a marketable limit order. So, JW, when you have these and you want to edit them, well, your limit should still be above, your stop should still be below where it's currently trading. That's kind of how they're designed for when someone is buying a security. One more question. It didn't come up here, but I get it a lot for those of you that are kind of thinking about the trailing stops. If you put, say, a trailing stop with a $1 trail or maybe a $5 trail, you will see that stop price on your open orders immediately, and that updates in real time. So in this GM example with a $5 trail, $5 below where it's currently trading at, so 36.60. And let's say it goes up intraday, it will go up and update in real time. It's not once a day at the end of the day. It's happening in real time, and you're going to see that. So hopefully that helps kind of explain not only the stop orders, but the trailing stop orders. So, Troy, at this point, maybe let me cover one more slide and then pick your poison when it comes to charting. I know we like to at least show one thing on the technical side. So maybe one more kind of way to help define risk before we talk about maybe one or two charting indicators, since this really isn't meant to be a heavy charting class. And that is another kind of version on the 1% rule. And since I brought up earlier, I thought why not talk about it once more. So as we kind of talked about earlier, where the 1% rule or 2% or whatever that percent of your trading capital rule, should you decide to establish it, how it can be kind of modified. It modifies automatically to your position sizing. Another way to kind of help create your position size with that rule is establishing that dollar value, establishing your risk per share, and that will help determine your position size. So what I mean by that, let's say that's still $100,000 hypothetical account. So 1% is going to be $1,000, right? And we are now looking on our charts. And I'm going to pick one more stock that came in here. Who gave in another comment? I see XLU pop in here. XLE. William gave us a XLE. So I'm just going to use this and I'm going to come right back to the slides for a moment. But let's say we're in XLE. Go to a blank chart. It's trading at $88. And I'm going to incorporate stops in this. I'm going to go to, well, Recognia's stop. And $85. Let's just use a round number of, say, $85. So in this case, let's say we're long XLE. We are wanting to establish a stop at $85. And we know, which is, say, $3 below where it's currently trading at. So we're only willing to lose $3 more on this trade, or we're thinking of entering this XLE position, and we're wondering, well, how big should I make it? I only want to risk $1,000, and if I lose $3 per share, I want to get out. So we're buying it at 88. We're going to put a stop loss at 85. So that's where that math then comes in. And going back to the slides, if we're only willing to risk $1,000 on the trade, which is $3 per share, well, how many shares can we purchase? Well, right, simply doing that math tells us that we can purchase, right, that 333 shares, right, at that, say, $88 price. And that will let us know, okay, if it goes down by that amount, in this case, $3, well, we'll be losing that kind of $1,000, or that will be a way to establish from our stop price and that 1% rule. So hopefully that helps there. Again, you start with that $1,000, look at the charts. I'm only willing to give it this much wiggle room. In this case, we came up with $3. We do the math, and that's going to tell us just how much or how many shares or how much capital we can commit to that position. So Arvind, I saw that comment. I'll show that once more, and then Troy, I'll pass it over to you. So within our charting tool within Active Trader Pro, we have this technical analysis button, and there is I like to think of it as suggested stop price. This is a third party. This is coming from Recognia, and you don't have to use it. This is just where they think a trader might decide to put a stop price. This is based on their own kind of proprietary methodology. They don't tell us their secret sauce. They looked in, I had an explanation, kind of a cryptic explanation from someone at Recognia, gave me years ago. They look a bunch of different factors. Again, he wouldn't tell me everything, but we can click on this and make it either a tight, medium, or loose. Interesting. The tight stop is kind of, well, right where we were, and we're breaking through it at the moment. So Arvin, hopefully that helps. But Troy, we can kind of end it there. I guess we could stop on the slides if we want. So if you'd like to add anything else, feel free to. If not, maybe we have time for one more indicator to help establish an exit plan. I'll leave it in your court at the moment.
Yeah, absolutely. I mean, just as a refresher, again, here's a couple. There's I think we should be aware of kind of the mechanics of that, but you don't have to use it. You can also set an alert. You can manually close. The idea of using a stop is, do you want your exit to be automated? Do you want it to be automatic? And sometimes you might want to have a little bit more of a manual oversight, but you also don't want to just ignore and you forget about it. You become busy with life. So if you're that type of person, a stop could be a really, really great idea in case you forget to check your account or are not aware when the market's moving substantially. But here's a list of different the shorter the moving average, it tells us shorter term trend versus longer term trend. Are you trying to trade around a longer term trend or a shorter term trend? Think about your trade or think about what you're trying to accomplish, and then think about what are the risks, right? Could a stock in the short term pull back, but could it still maintain a longer term concept of an uptrend? And many times it can. So finally, volatility indicators, and here's one, average true range. Volatility indicators can help us understand how volatile is a stock in normal conditions. And we want to be careful when we're placing stops too close. If you find yourself getting stopped out a lot, it's really frustrating. You might want to ask yourself, is my stop too close? Is my stop reasonable? Am I choosing a reasonable distance from price where, apart from just normal daily fluctuation, is the movement against me going to be a clear indication that my trade is not working? So let's take a look at this. One symbol we got was XLU. And again, just looking at a plain chart here, this is a pretty positive looking chart from a bullish perspective. Let's add some moving averages, those moving averages that I showed earlier. You can see here, it's not really telling us something we don't already know. We knew the stock was, or the ETF was trending up, but now this adds a visual that could potentially help us with our decision making. And by the way, you could play around with these figures. You could use a 10, you can use a 50, a 150, whatever values you find are going to be helpful. So with this information, how might you plan a trade? Could you say, okay, Troy, this is in an uptrend. I'm going to place a bullish trade, betting that it's going to continue to go higher. Well, how much of a retracement are you going to allow that's going to invalidate, I should say, that thesis? Again, I'm looking at this area, and you might use this and say, okay, right around 72 and a half, maybe I want to put a stop there. Maybe I want to give it a little bit of room if it gets close there. So maybe I want to put my stop at 72. And let's just draw a line there just for visuals. I'm going to put it at 72. I'll keep it green for now. Now you might ask yourself, is that a reasonable distance based on how this ETF trades? Well, we could use ATR, we could use another volatility indicator. And for example, ATR basically just says over 14 periods, how volatile is it typically over a 14-day period? And we can expand this and we can kind of see over different periods of time, even at its most volatile, it tends to only be about 1.3, 1.35 or so. And it's been right around 1 for a while, starting to tick up a little bit. So how far away is our stop? Well, at 72, if we enter at 73.81, that's $1.81. That's kind of close to that 130 that sometimes it's been at in periods of higher volatility. So that might be an indication my stop might be too close. Again, could it not, hit your stop? Could it bounce around and head higher? It absolutely could. But you want to, again, ask yourself, okay, if it's too close, maybe I want to move it a little further back. Maybe I move it down to maybe this 20 period moving average right around 70.83. That's about $3 away. That suggests that it's less likely in just regular daily volatility. It's less likely to be triggered without having multiple daily sequences of bearish price action. But now you might ask yourself, okay, if I'm going to use $3 as my stop distance, how much risk do I want to put on for this trade? It's going to depend on your account balance and what's kind of a palatable loss for you. That 1% rule is a really great kind of rule of thumb, especially for new traders, because 1% is not a lot of damage on your portfolio, right? And you trade big and you lose big, it's going to be really painful. It's going to be really frustrating. So if you say, all right, $3 per share, let's say you have a $100,000 portfolio, 1% is $1,000. You would take $1,000. Let's see here. Let me get a calculator out. Can't do that in my head. $1,000 divided by $3 a share. So let's see here. If you put, let's see, $1,000 loss divided by $3, that means if we purchased about, 333 shares around there, a third of 1,000, a $3 per share loss, that would give you about $1,000 loss. So again, that's just an idea, kind of a guardrail to kind of think about sizing. You can use round figures. You could say, all right, 333, maybe I want to round it down to 300 shares, whatever you'd like to use that. So again, that's just a kind of a general rule of thumb that you could use that could help you visualize trading. In addition to ActiveTrader Pro, you can use, James, I'll just kind of shift over. You can use the Chart Plus or the trading dashboard. They use the same, kind of data or software. If you're wondering where the stops are, it's a little bit different on the trading dashboard and the Chart Plus. You go over to events here. And whereas in ActiveTrader Pro, it's under the technical analysis tab. And you'll see here, there's support resistance, there's also stops, and there's a little gear icon. You can modify it and you can say, do I want my stop to be tight, medium, or loose? Again, that's based on how Recognia defines it. So give it a grain of salt here. For example, if we look at a tight stop and we hit apply, it's going to put its tight stop is right around 70.6. And that's actually pretty close to where we were looking, right at the 20 period moving average. And that defines it as a tight stop. If instead we want to see what does a medium or a loose stop, if we hit medium, it just moves it further away. And then on a loose stop, it moves it even further and it goes lower than this longer term pivot point. So again, the further away your stop, you just have to trade smaller because you want to, if you're keeping kind of the same fixed amount of risk tolerance, the more volatility you allow, the smaller you need to trade. in order to kind of protect yourself. Now, this is the risk perspective. What's the reward? What's the opportunity perspective? So think about how much you're risking and think about, okay, a trade can go against you. It doesn't have to literally be a huge monumental loser. Could the trade start not working out and trading down here? You can close it early. You don't have to wait for a max loss. You can close and say, it's not doing what I want. For example, if I go back to Active Trader Pro, maybe this green line's our stop. Well, this maybe we want to keep that as a worst case scenario. And maybe if it starts trading under this area, maybe you don't want to stick around and find out. Maybe if it starts trading around 72, 71 and a half, maybe you want to say, you know what, if it starts trading there, I don't want to stick around because it's not doing what I want it to do. So I think with risk management, you want to think about, worst case scenarios or really adverse scenarios. And as long as you're prepared for that, a larger amount of the time, it may not be a huge loser. It might be a small loser. And again, as traders, we want to have small losing trades, big winning trades, and ideally we want to be more frequent with our winning trades. Sounds simple, but it's very difficult to do. And so again, we trade small, we start small, we develop some progress, and ideally we need to have a couple different tools. So we can trade long stock down the road if it's suitable for you, if it's suitable in your goals. Maybe you want to explore learning options. We have a lot of educational content in terms of learning how to trade options. Options is not for everyone. So you have to decide if that's going to be for you and if that's going to help you with your trading. So I think we've talked about enough, James. I know we're past time. At the end of the day, a lot of this is stylistic. So what works for one person may not work for another person, especially if you're more of an investor versus if you're more of a trader. At the end of the day, you need to have some plan, and certain techniques are going to be more useful for others. But the idea is some plan is better than no plan. And ideally, it's best to have a plan in place ahead of time when you're placing your trade rather than waiting for a trade to go significantly against you and then wondering, when should I get out? And sometimes it's too late at that point. So, James, I'll leave it there. Any last minute thoughts, comments that we want to address before we close up here?
I'll try to answer as many questions as I can, maybe a quick lightning round of some of the ones that were sent in earlier here. And let me go ahead and share my screen. First one that came in, Pauline, and actually, Pauline, I don't think I've seen a comment from you from a while. So welcome back to the Q&A. Please show how to get to the dashboard. To get here, this is really easy. From Fidelity.com, accounts and trading dashboard, fourth one down. Fun fact, for those of you that remember 6-7 years ago when there was the ATP on Fid.com, it's kind of in the same spot. So that's how you get to the trading dashboard. Arvind, you brought up what Troy showed, but JW, you brought it up as well, just in case, to knock both those questions off, right? Getting stops in trading dashboard, you're going to click on the events, click on this, and JW, I think this is what you were looking for to modify the time frame, right? We click on that little gear, and now you can do above or below. Above if you're short, below if you're long. Most will keep below. Then you can choose tight, medium, or loose. Click apply. So hopefully that helps there. So Arvin and JW. Another question that came in was just how to decide how much of a trail to enter and how do I add the ATR ATP. So from indicators, it is something that you can add, right? Average true range. And within trading dashboard, they have the ATR trailing stops. When it comes to and here you can see these are the ATR trailing stops. It kind of takes the ATR, if you're using it to create a volatility stop, which is what average true range is, and I apologize, I know we really didn't cover this, but keep in mind, this is more for the technical analysis focused sessions. But if you caught that, let me add it back once more. The ATR trailing stops is it takes what the ATR has and then adds the multiplier, does the math for you, so you don't have to do the math like where we've talked about 1.5 or 2 or 3. When it comes to the time frame, I like choosing the defaults. I think the multiplier on this, you'll want to choose your own, whether it's kind of a minimum 1.5 or greater, maybe upwards of 3. And you will notice if you go to average true range, the default is 14. That I like using the default parameters, so which would be 14. Now the trailing swaps does use 21 there. So maybe you can even adjust that to 21. I would say for anyone thinking about modify something like ATR, stick with the original ones. Why? Because, well, it's kind of what the intender create, kind of the creator intended for, got those words mixed up. The creator intended for a trader to use. And if you're starting to adjust it, have a particular reason why. Chino, I saw your comment. How do you differ between stocks holding long term versus short term? And there's no real kind of set formula to do so. And it's just, what is your opinion on that underlying? And it doesn't have to be an all or none scenario. I've spoken with, especially with a few stocks as of late, where they have a long-term holding position. They'll have some shares. Let's say you've got Apple, right? You've got you're long-term bullish on Apple, but maybe only a portion of those shares. Let's say you have 1,000 shares. Maybe 500 are you consider long-term, and maybe another 500 you're trading kind of in and out, and you're choosing those lots. You're not too worried about wash sales and that kind of thing. But it doesn't even have to be multiple. Some stocks are long term, some short. It can be the same term. It's just, are you in something and you're going to ride those ups and downs, or are you trying to profit on the noise, right? In that longer term trend where you get different stages, let's say it's always going up. If you're just trying to ride that uptrend, well, that's a long term, that's an investment. But maybe you're trying to make profits on the noise, right? The kind of gyrations within a longer term trend. That's that shorter term trade. So hopefully that helps. Terrell, you had this question there, and I think it's good. It kind of answers JW's as well. So Terrell's question was, some ETFs and stocks have very little volume, and they can get kind of stopped out if there's high degrees of volatility. And that is something that is an issue, right? There's never going to be a situation where everything is, it's a kind of a win-win scenario in many regards. Stop orders have that risk of being stopped out, which is a period of time where extreme volatility maybe moves price in a bit of an overreaction. And the kind of the best example, and we're going to lose it on the 10-year chart shortly, which is going to be quite a sad thing, was this time back in 2015. As you can see, IVV, this is the S&P 500 ETF from iShares. Open, close. Well, look at that range, right? That is an example. If you had a stop order, say at 180, 170, that is going to hurt. The stock during this day, I think this was due to a China. I remember this was a wild day when I was assisting clients back then, but the price dropped in the morning and then immediately snapped back up. So all these folks that got stop orders sold at a low price, and then they were kind of stuck buying back in, and that's a risk. Doesn't even matter sometimes the volume. Look at SPY. It's not to the extent of IVV. Do I still have it here? Here we go, 2015. It's not to the extent, but there is still a little bit of an exaggeration on that. But there were quite a few stocks that did that. Fun fact, if anyone likes the kind of anecdotes here, there was someone that I was working with. He had a random buy limit order to buy at a low price, didn't think it would ever fill, and got an amazing fill. So sometimes those kind of I don't know, those kind of opportunistic far away buy limit orders can be advantageous. But Terrell, JW, that kind of answers your question. Maybe not all stocks you put a stop order. That's what you've got the alerts for, right? You can set an alert, a price alert, so you can be alerted if there is maybe a price movement right below such a dollar amount. Right? SPY moves below 500, you're going to send yourself maybe an email or text or a push notification in those situations, because stop orders are just automation for the most part. Ideally, if you're trading, you still want to take an active kind of look at it. But we'll end it there. We're already kind of well past time here, and I do want to be respectful of your time. A lot of great questions that came in. So hopefully you found this session helpful, right? At the very least, kind of informative, and you understand the importance of having an exit plan, planning your escape. So on days like today, you don't make emotional decisions and you feel comfortable no matter what the market throws at you, no matter what the stocks throw at you. So until next time, everyone, please be safe out there. Best of luck on any trades that you decide to place, and hope to see you all in another session, possibly really soon. Appreciate that, and have a great rest of the day, everyone. Thank you, Troy.